welcome back to lesson number 3. So this is the first lesson that is actually going to go deeper into the bias series. I've decided to make a bit of a series because there's quite a few topics and we can get into each one in a decent amount of depth. The first thing we're covering today is the DXY. You've probably seen me and the other admins throw around, this word or term, the DXY, right? And especially for me, it's very pivotal in the way I trade. So that's why it's going to be one of the first things that I'll show you guys. I'm going to show you guys 2 different ways to use it today, known as SMT, which is a smart money trap, and Divergence. Let's get into it. So the DXY, right, is basically the US dollar. If you go to the DXY chart, in the top left, and I'm going to show you guys in a second, it says the US dollar index. So it essentially tells us how much the US dollar is worth. And it's a net, or like a lot of different factors are added together and calculated to get the number that's given, right? What is the US 10-year? So this goes into a bit of economics and stuff. I'm not too keen on teaching that one because I'm not an economics teacher. I'm not too well versed. But I'm going to link you guys a playlist on YouTube, has a bunch of episodes. This is where I started learning a lot of my economic knowledge. It's not, everything, but it helps give you a very good foundation, and it will speak about the US 10-year. It will speak about the US dollar in general and other things to do with economics. So I will drop the link for this, I've already dropped it by the time this video comes out. So you guys can go ahead and watch this, right? But in terms of technical analysis, in terms of TA, how can we use this, right? The DXY, the US dollar, follows the US 10-year. So when we need bias for the DXY, right, we expect the DXY to follow in, the US 10 years tracks. So if we know where the US 10-year is headed, we can know where DXY might potentially be headed. Why is this important? The DXY is the US dollar, right? If you see all the pairs and the crypto that we trade, they're traded against USD, right? Or you could say USDT, but USDT is meant to be 1-for-1 USD. So what this means, right? If these things are traded against the US dollar, the direction that the US dollar is headed in will affect their prices. So if you can know where the US dollar is headed, where the DXY is headed, it's going to help you to know where the other things may be headed. Now, we'll get deeper into this, but this isn't always perfect. There's levels of correlation. In school, in maths, you guys probably learnt, right? I think usually they show a graph with 4 types of correlation. You have strong positive, weak positive, strong negative, and weak negative correlation, right? And there's different types and they're going to come into use. But let's get on the charts. Okay, so this is the monthly chart for the DXY. If I come over here, this is the monthly chart for the US 10-year. Now, before you guys say, I know they're not perfectly correlated, right? They're not. It's not brilliant. It's not 1-for-1. But in a general sense, they do follow each other. As you can see, it had a little bit of accumulation, then it has this strong move up. And what can you say? We have this accumulation, we have this strong move up. If we drop a time frame, if we look more locally, also come here, drop a time frame. You can see, relatively, they do something that looks very, very similar. Made a high, we've started retracing. Made a high, and we started retracing, right? One thing to note is that the US 10-year, in a way, is ahead of the DXY. So what that means is the US 10-year might make a move first, and the DXY might lag a little. It might lag by, a few days, a week or so. So how can we actually use the US 10-year, right? What I want you guys to realize, the next one I'm going to say as a rule of thumb, not just to do with bias and everything. If I took away all of this stuff where it says US 10-year, I took away the fact that it says weekly, and I just gave you this candle chart, and I told you, tell me what's going to happen next, you guys would just analyze it as a normal candle chart, right? Just, any other chart. That is what you should be doing. You need to treat every chart the same. Price behaves essentially in the same way. We call it fractal. The market is fractal. It's the same on all time frames. Now, your weekly and your daily will have a bit more, emphasis, and they'll be in sync with news and real life events, right? Whereas, your 1 minute isn't going to be affected by the news that's coming on Friday if today's a Wednesday and you're trading the 1 minute chart, right? But what I mean by this is when we look at this chart, there's nothing to kind of, I guess, be confused or scared about. We need to treat it like a normal chart. So now that the US 10-year was dropping here, right? Where was my target? So, of course, I'll mark this up quite regularly. I don't show this in the weekly outlooks, of course. But I was looking at this order block. So until the US 10-year hit this order block and had a very, strong rejection, I've been bearish on the DXY as well. I've just been waiting for the DXY to come. And this won't always happen. But as you guys can see, right, there's also a weekly order block here. So I've been watching this weekly order block for the DXY while I was watching this one for the US 10-year. Now, you see the thing here is, right, the US 10-year hit its order block, yet the DXY here didn't. So now I guess you could ask, what's the next step, right? Well, the next step is to watch what the US 10-year does. It's possible that, we tap this order block and now we decide to keep moving higher. We then go and make a new high. Of course, it will take a few weeks. And the DXY might just never tap this order block. It's possible. But we need to use the US 10-year mainly on the higher time frame. I don't use this on a 4-hour, 5-hour, or whatever. Not on our lower time frames. I'm always looking at the weekly and the daily charts to find where price may be going, and then trying to line it up with the DXY. Let's get back to the presentation. Okay, so let's treat that as a bit of an introduction, right? How the US 10-year and the DXY work together. The star player is still the DXY. And the way, of course, this is dumbed down and simplified, but the way I've taught it is the DXY is in charge, or you could say in control. We always look for the direction of the DXY first, of the US dollar, and then we attempt to pair it up with whatever we're trading. So the first thing I want to talk about is divergence, right? What divergence means is that we can use the DXY in sync with certain other pairs. And I do this every single day. I do this. And we're going to get into how. And the next thing is something called SMT. SMT is smart money trap. And this can kind of lead to confusion. And it'll kind of tie in with why I've taught you guys breaker structure and market structure shift in the first lesson. But let's get back on the charts. Okay, so now that we're back on the charts, right? Again, we're looking at the DXY weekly chart. And I have all these things marked up, have our order block. Let's just get rid of this for a second. I have an imbalance on the weekly marked up. This is where price could come, right? This is the current range for price. It's the internal range. That's what we call it. You can say this is the current range for price. I've been waiting for price to come into this order block or this imbalance and react. It came into what we call the discount and reacted anyways, right? Now, in terms of divergence, right? Do you guys remember when I was talking about correlation, talking about strong positive, weak positive? We can say that the US dollar and the Euro USD have a strong negative correlation, right? So what is divergence? Do you remember that first lesson I taught you guys and I showed you market structure, uptrends and downtrends, higher highs, higher lows, lower highs, all of that stuff, right? Divergence, right, is when you can see those things on the DXY and Euro USD, or at least divergence in this context, by the way, not as a general term, is when we're seeing the opposite things happen on the DXY and the Euro USD. So on the DXY, right, you might be seeing a higher high. And then on EU, you might be seeing a lower low. So usually when we see this, they're in sync. Do you guys remember I told you on on the US 10-year and on the DXY, you can't essentially go on your lower time frames and look at them. Now with Euro USD and the DXY, it's the complete opposite. I look at all my time frames. I line up my weekly, I line up my daily, my 4-hour, my 1 hour, my 5 minute, 50 minute, whatever time frame I'm trying to, put my trades together. I line them up. here's a quick way to look at it, right? So today's daily candle here is bullish, right? If I come on the DXY, it's bearish. Now let's look at the daily candle before. Bullish, right? You can see ours was strong bearish. You see the resemblance. Strong down candle, strong up candle. Now, I'm not going to do it, but if you want to, just look back at every candle and see that each candle, for everything that's happened at DXY, you see the opposite here. And like, let's just imagine we're glancing at it. We're seeing a lot of wicks around here, right? If we come here again, what do we see? A lot of wicks, this, kind of small consolidation. And we see the same thing here. Now, that is what divergence is, right? How they're in sync and we can use them together. We can use them to essentially frame trades. So, talking about framing trades, right? Now, let's come on to a lower time frame. Let's say, right, price was here and we have a market structure shift, right? Hope you guys can identify it for our market. We have a market structure shift here, right? You guys see why? We made a lower low, lower high, and then we go ahead, make another lower low, and then we go into a high high. So now, if I mark it from there, so my bias here was to go long, right? Meaning, if I'm expecting the DXY to go long, what am I trying to do? Just as a side note, before people get confused, we don't trade the DXY. We use DXY as an indicator. We talk about these indicators, the MACD and everything. They're not real indicators. This is a real indicator because you can use it to kind of support your trading and give you real direction. Okay, cool. Now, let's just frame this quickly, right? Consolidation, strong move down. Now you got a bit of a weird consolidation again. If I zoom out on this, what do we see? Consolidation, strong move up. You got this weird consolidation. Let's just go back and forth, back and forth. And these are both the 5-minute time frame. See how closely they're moving together. Of course, they're just, in opposite directions. What you can do with this information is literally start framing your trades together, right? Let's say I've come on EU and I've decided, okay, cool. From here, I want to be longing. I want to find a long trade. And of course, this isn't a real trade example, but let's just say we're taking this, right? And we decide we want to take this order block. What I would do is go on the 5-minute, go on my DXY, and frame the same thing. Now, what's happened here, right? Let's zoom in a bit. We have the same order block, but the opposite, of course, because here it's bearish. Over here is a bullish order block, right? This correlation is very nice right now. You see how there's a small gap at the equilibrium. Equilibrium is the 0.5 and the order block. And it's something very similar here. However, the DXY is just slightly closer, right? What this means is I want to watch the DXY because you know what can happen, right? I can have a long position set up here at the body of this order block. And let's just say my stop loss is here, for example. Take profit here. So now where is my entry? Near enough at the 0.62, right? Now if we do the opposite, of course, short position. Again, we're not trading DXY. This is just a good tool to see, what price can do. Take profit here. Stop loss there. Okay, cool. So what I'm trying to say to you guys is we watch the DXY, right? This is another reason that I personally don't send a lot of forex signals. I don't take any limit orders. Of course, I'll send in signals as limit orders, but me personally, especially because I trade on the lower time frame intraday, I don't really trade the 1 minute, but the 3 minute, 5 minute, and 15, right? I wait for the DXY. Once I've found the places that line up, I'll wait for the DXY to come up here, tap this order block and react. And what might happen sometimes is the DXY taps first and reacts, and then price moves away. So when this happens, I market execute. Whereas, if you just stay waiting for the Euro USD entry, what might happen is you might come right here, like very, very close, but you get missed and it moves away. And that's because you didn't pay attention to the DXY. So with all your setups, high time frame or not, we blind them up, and then second, we watch on the DXY for the reactions to actually get into a trade. So now let's talk smart money trap. Of course, they have a correlation, and they do correlate, right? As you guys can see, I've shown you now. What is SMT, smart money trap? We have, so let's say this is going to be Euro USD, right? We have an uptrend. And then we have what looks like a market structure shift. So you think that price is going to come back here and you're going to short, but guess what? It goes to your stop loss. Now you're confused on why this happened. Some of you might have already noticed this, right? Of course, the moves and the candles are very similar, but it almost looks like the moves on the DXY can be a bit bigger sometimes, a bit exaggerated. Now, let's just imagine this is the Euro USD. So what do we see on DXY? Something similar. Downtrend. You come down. And now here we've come very, very high. But we have not broken this high. So therefore, what? It is not a market structure shift, right? Let's make this one a different color. Let's just make it orange. Cool. So this is, let me just leave this. Orange is the DXY, blue is the Euro USD. So now what would have happened here at this low? You would have thought this is a market structure shift. Now price is going to retrace, and I'm going to short down on Euro USD, and you can be laughing with your 3-4 or whatever. But then your stop loss gets hit, right? And now you're wondering, why did your stop loss get hit? Because you have to watch the DXY first. I've been in this situation, this exact scenario that I'm describing to you right now. My stop loss has been hit like this. The DXY is in charge. We need to wait for the market structure shift on the DXY as a confirmation, whatever time frame you're looking at. Over here, it came very close, right? You might have even thought, oh, we're about to have a market structure shift. But of course, you have to wait. You have to wait for this high to be broken to actually know, right? But we didn't break the high. We just came very close. There might have been, I don't know, a 1 minute order block up here. We tapped it and we moved back down. And on the Euro USD, what happened is we swept the low. And now you thought it's a market structure shift, but really we just carry on because we have to know what the DXY is doing to frame the direction for Euro USD. So now any trades I take, both my Euro USD and my DXY need to be in line. When I find my daily bias, I have to look on my DXY and my Euro USD. If I'm waiting for DXY to fill an imbalance, and I might find a similar imbalance on the EU, what do? I look at the DXY and wait for the DXY to react, either by filling it fully, filling it, halfway, whatever. We just wait on the DXY. The DXY is in charge. With Euro USD, there is very, very strong correlation. Like I'm showing you guys on the 5 minute even, right? Low time frames. However, it's not the same on all pairs, and other pairs will be affected by other things. There could be news coming up. For example, you can trade USD CAD and use DXY as your indicator. But if there's Canadian news that day, the market may not move how you expect it to. And I will get into that, preferably on a Zoom rather than making a whole lesson on it. And we can kind of go over how price behaves and how to use the DXY on other things. For now, the way I'm teaching you guys for Forex specifically, we're going to be paying a lot of attention to the Euro USD, GBP USD, and the DXY. So the last thing that I'd like to touch on is finding our actual bias. So what does this mean, right? I already kind of got into it and framed it for you guys. I'm not going to show you on the charts this time. Let's talk through it. We find our drawn liquidity. So some of you may not know what this means. And I realized, a couple lessons in now, I realized that some guys don't actually grasp the concepts of liquidity, imbalances, and some other smaller things. So we'll do a zoom for those soon and go over them, right? We find our drawn liquidity. Our draw on liquidity is always BSL, which is buy side liquidity, or SSL, which is sell side liquidity, or an imbalance. Those are the three draws on liquidity that you can have. That is what price is drawing to. We find the drawn liquidity for the US 10-year. Then we use that to find it for the DXY. Once we found the drawn liquidity for the DXY, we frame something similar but opposite for the Euro USD. And that way, we just wait for reactions before we enter our trade. Remember, I've mentioned it a few times now. The reason I've taught breaker structure and market structure shift first is because I want you guys to understand confirmations. As traders, we don't trade anything without receiving a green light from the relevant pair or from the relevant market structure, waiting for a market structure shift on the 15-minute, for example, or so forth. So this is how I find my bias. And I've shown you guys, I've kind of broken it down. I want everyone watching the weekly outlooks that we put out, because I want you guys to see how I do it every week, and I do it live rather than, just talking all this theory to you. Of course, it might make sense, but the application of it isn't as deep. You'll start to see that it's very, very simple over time, and it does become easier the more you do it. But that's about it for today's episode. I'm going to try and get out another episode this week, a shorter one on a different bias topic. And if you guys have any questions, just hit me up. I really hope you guys can't hear my MacBook fan in the back because that's really loud. If you can, I'll just try and fix it for next time. But catch you guys in the next episode.